Hi everyone, Isaiah Riel. I hope you're doing well. In this next video, we're going to share with you how to make a moderately conservative portfolio. So if you saw the last video of us making a conservative portfolio, the two main focuses we talked about are going to be the same. Those are being focusing on income and focusing on stability. So we're going to focus on those two key aspects when building this portfolio next. I'll share with you the different investment allocations. I'll share with you the percentages. I'll share with you the average annual returns that Charles Schwab found by building this portfolio. Without further ado, let's get started. Thanks so much for watching. Hi everyone, and welcome to the Real Sense podcast, where we bring you bite-sized advice to help you make real sense of money, the markets, and helping you create a legacy for you and your family. Wherever you may be, however you may be listening today, thank you for making us a part of your day. I'm your host, Isaiah Riel, financial advisor with Laguna Wealth Advisors. In today's episode, we are going to help you create a moderately conservative portfolio. As I mentioned in the intro, today we're going to build a moderately conservative portfolio. And a moderately conservative portfolio is going to fit someone, perhaps yourself, if you're more on the conservative side. So your two main focuses are going to be on stability, maintain the money that you have, and also two, income. You want to be able to provide income for yourself through your investments. But the difference versus a conservative portfolio is that with a moderately conservative portfolio, you're willing to take a little bit more risk in the markets, meaning that you're willing to increase the percentage of how much money you have invested into stocks. So we're going to talk about that today. In today's episode, I'm going to talk with you about what type of people are typically invested into moderately conservative portfolios and why. We're going to go step by step of building a moderately conservative portfolio and show an example via Charles Schwab of what that type of portfolio would look like with specific investments and percentages. And then lastly, we'll talk about outcome. By investing and creating a moderately conservative portfolio, what kind of outcomes typically happen when we invest into a portfolio like this and create one for ourselves? Without further ado, let's go ahead and get started. So who would fit in a moderately conservative portfolio? Typically, people who fit in a moderately conservative portfolio are going to be people who need two things. They need income and they need stability. But they're willing to take a little bit more risk. For example, perhaps this person could be a retiree or a pre-retiree. But they have enough money saved where they're willing to put a little bit of that on the table, take a little bit of additional risk in stocks, in equities, to see if they can get that risk-reward relationship. With the more risk they put out there, the higher probability for reward for that amount of money. So for a moderately conservative portfolio, majority of the time they are going to be leaning towards someone who is retired or pre-retiree. Perhaps they could be someone in their 50s who are slowly beginning to plan for retirement. So little by little they're adding more monies to bonds. But in this case, we're going to say that an example is someone who is retired or someone who is just about to retire, who has enough money saved where they're willing to take a little bit of risk. But their main goal, their main concern is going to be that they want to provide income. So they want income generation from their investments, and they want their money for the most part to be stable. They want it to be maintained and be there for the rest of their life, hopefully, is what they would like. So how do we build a moderately conservative portfolio? How do we build one, and what does it look like? There are 5 key components that you need to review before you build a moderately conservative portfolio for yourself. I'm going to share those 5 key points with you, examples as to which type of investments you can possibly choose for each according to what the Charles Schwab model portfolio is suggesting. And also too, I'm going to share with you the percentages of how much to put into each investment via a template from Charles Schwab. So let's start with the foundation. Let's start with the piece that's going to be the solid foundation to build your portfolio. If you're looking to build a moderately conservative portfolio, we're going to look to put about 50% of our money, so half of it, into fixed income. What's fixed income? Fixed income are corporate bonds. It's treasury bonds. They're bonds. They're investments that are focused on income and stability. So according to Investopedia.com, fixed income tends to have periodic income received at regular intervals and at reasonably predictable levels. So in layman's terms, what it's saying is that these bonds provide a consistent income stream. Usually corporate bonds or treasury bonds pay you on a monthly basis or quarterly basis. So people who are invested into these bonds know that, hey, every month or every quarter, most of the time, I'm going to get some type of income generation back from these investments, whether that's dividends or interest. At the same time, these investments provide stability for them because they know that their bonds, they're not going to be swaying as much as if they were invested into the stock market. So 50% of the money is going to go into fixed income. The next portion, 10%, is going to go into cash and cash investments. So examples of those would be a savings account with a bank, a high yield savings account where you put your money into there and you earn interest by holding your money there. It can be CDs, treasury bills, money market funds. The purpose of having money in cash investments is because it maintains the money. It preserves your capital. Because, for example, let's say the stock market's going up and down, left and right, sideways, everywhere in between. It's extremely volatile. You have monies in your savings account at the bank. You tell me this. If the market's extremely volatile, and is your money doing the same thing in your savings account at the bank? No, it's not. It's staying still. So that's the key point for these cash investments. These investments are going to be very liquid, meaning that you have access to these investments very quickly if you have to. But more importantly, they're going to preserve your capital. It's going to be there again as another additional layer to that foundation for your portfolio. The final 40% of your portfolio is going to be made up of stocks and different kinds of equities. Let me go into more detail about how to position those stocks and the percentages. 25% of the overall portfolio is going to be put into large cap equity. Large cap equity are some of the biggest companies out there that we know. Examples are Amazon, Apple, Johnson & Johnson, JP Morgan. Those are the big time companies that we're investing monies into. These companies have a market capitalization of over $10 billion. So these are the big time players. We know that these companies are stable, that they provide some very consistent returns through historical data. They're not going to be providing extremely high returns than extremely low returns. You know that you're going to get a solid return on average in these investments. And also too, depending on what type of investment you decide to pick, they pay you out dividends. So people like to use this as a core piece of their portfolio strategy because again, they're going to be very stable for your portfolio, and most of the time, depending on what you invest, they're going to give you some type of dividend for holding on to that stock. So 25% of the overall portfolio will go into large cap equity. 10% of the portfolio will go into international equity. Before, we were putting 25% of our monies into large cap equity only here in America. This next 10% is going to be invested abroad. The reason why we invest money abroad is because, for a couple of reasons. It helps to diversify our portfolio. So like the old adage says, we don't put all of our eggs in one basket, or you shouldn't put all your eggs in one basket. It's sort of similar in the sense of you're not putting all of your money in the US stock market. You're able to diversify, you're able to invest in other parts of the world. That's what investing internationally does. It allows us to diversify, to lower the risk and get other areas of the market. At the same time, like I just mentioned, it also helps lower our overall risk in the portfolio. Since we're not putting all of our eggs in one basket, we're putting it into different pieces. Because of that, we're decreasing the amount of risk that we're adding to the portfolio. Also too as well, there is potential for higher returns abroad. Because of course, at times through history, there's been moments where the stock markets overseas have performed better than the US stock markets, and vice versa. By investing some monies overseas, you're able to have access to that potential ability to be able to have returns, that you wouldn't so much be able to have over here in America. So 10% would be invested into international equity. For international equity, those would be invested into the largest companies overseas majority of the time, depending on what type of stock fund you pick to choose. Typically, there's equity funds, large cap equity funds that you can invest your monies into. Similar to the US equity, will provide a stable return. They may provide you a little bit of dividends. And the last 5% is going to be invested into small cap equity. So small cap equity, what is that? Those are companies generally with a market capitalization between 300 million to 2 billion. These aren't startups per se. These companies have grown out of the startup realm and now they're making some real money. But compare them to the Starbucks, the Apples, the Amazons of the world, so they're not making as nearly as much as those guys. They're a great tool because they allow you, similar to international, they allow you to diversify your portfolio and they offer you more room for growth in a portfolio. However, the thing about small cap, and the reason why I'm only at 5% is because you're taking on additional risk. Small cap equity have tremendous risk and volatility when you invest into them. A lot more so compared to large cap companies. According to Investopedia.com, historically, small cap stocks have outperformed large cap stocks. So it makes the investors more money. However, they tend not to be as stable as these large companies because they're more erratic. They may provide some more volatility. Yes, they may give you some higher returns, which is great, but you may have some lower returns too as well. So again, it's that risk-reward relationship. If you're willing to take that risk, the reward might be higher. There is potential there. So 5% of the monies would look to be invested into the small cap equity, and that would make the whole creation of the portfolio. So as a recap, the foundation of our moderately conservative portfolio is going to be with that 50% invested into the fixed income, so the bonds, because they're going to be providing us income in the form of dividends and interest from the bonds we invest into there. Also part of the foundation of the portfolio is going to be that 10% invested into the cash investments, because by putting the monies into the cash investments, we're preserving our capital. And the final 40% of the money is invested into stock and stock funds. Again, 25% of the entire portfolio is going to be in the large cap equity. They're going to provide a stable return historically. And then we're adding 10% of the overall portfolio to international equity. That's going to allow us to decrease the risk in our portfolio. It's helping us to diversify, and also to gives us the opportunity to get those returns that we may not be able to get here in America. And then lastly, that last 5% is going to be invested into small cap equity companies. So they're smaller companies, they're not startups, they've grown out of the startup phase, but again, they provide higher risk compared to those large cap stocks. So my friends, that is the creation of the portfolio. We put 5 different key items in there, and that's going to create this type of portfolio that allows us to get income, allows us to remain stable. However, we're willing to take a little bit more risk for that potential for higher return. That's how to make up the moderately conservative portfolio. Lastly, transitioning to outcome. So what's the outcome typically for a moderately conservative portfolio? We're using the Charles Schwab template for building these portfolios. In addition, they do share an average annual return, for example, based off of historical data and their analysis, granted, is to give you an idea as to possibly what type of average return you may be able to see by investing into a moderately conservative portfolio. So Schwab says that for the type of portfolio and invested that specific way with those percentages into those specific investments, an average annual return will be roughly about 9% on average. That gives an idea and a return of what type of outcome we can see by investing into a moderately conservative portfolio. My friends, with anything else, with any questions, please feel free to leave a comment for us. If you haven't done so already, please like us on Facebook and Instagram as we provide additional videos, content to help you with your investment journey. I look forward to talking to you soon. Have a great day. We'll talk to you real soon. Thanks so much.